Welcome, dear traders. Today, Asian stock indexes dropped to their weekly lows. The sell-off continued the wave of declines that swept Wall Street the day before. As a result, Japan's Nikkei lost 1%, and stock indexes in Australia and New Zealand retreated from three-week highs. Following their global counterparts, China's stocks also slumped. Uncertainty was the main driver that reversed markets. This time it was the head of the Federal Reserve. Jerome Powell, like many central bank officials, is still not sure that the current settings will be enough to curb inflation. In his speech in Washington yesterday, he admitted that the regulator was not completely confident that the rate hike cycle was over. That the next hawkish move could come in early 2024 or even as early as the next month on December 13. Indeed, a lot will depend on the incoming economic data. In this regard, Jerome Powell's comments were supported by the weekly report on unemployment claims, pointing to a robust labor market in the United States. Depending on the strength or weakness of the current data, the sentiment in the markets is expected to change even more. This rise in Treasury yields and the US dollar rally were predictable after the Fed's hawkish outlook. However, the greenback jumped to 105.90 on an upward momentum yesterday. Notably, the US currency began today's Asian trading session near this level, and the US dollar index slowed down early Friday and moved within a narrow range of 105.80 and 106 below. On a Tuesday, when the US consumer inflation report will be released, the positive scenario for the US Treasuries and the US dollar may be revised. The greenback may close this week strengthening against the antipodean currencies. It may also reach an early high against the yen. And the dollar-yen pair reacted to the hawkish comments from the Fed's governor on Thursday night and jumped to 151.30. Meanwhile, the bullish momentum was intact in the early Friday trading. As a result, the yen spent most of the Asian session also on the rise in the range of 151.20 and 151.50. At the same time, bulls continued to push the Japanese currency lower, testing the patience of the Bank of Japan. Although the yen has come close to possible intervention by Japanese officials in September and October, it has not yet fallen that low. Some analysts have put the point of a possible intervention on the level of 152. At the end of last year, in September and October, the intervention took place at the lower levels at the opening of the European session, and today's small dip and retreat to 151.30 may also the result of such intervention. Since it was short-lived, this reversal could also be due to other reasons. The Japanese authorities will not comment on the auctions to avoid speculation on the yen. Chinese officials are also avoiding direct comments when it comes to supporting the crippling real estate sector. The Chinese real estate sector accounts for a quarter of the national economy. Meanwhile, the list of developers caught in the default trap is growing. In August, it included Country Garden, the country's largest developer. Its official default came after it failed to pay $15 million in coupons on its offshore bonds on October 18. And this week, Reuters reported that Chinese authorities had asked domestic financial giant Ping An Insurance Group to acquire a controlling stake in a Country Garden. Ping An did not comment or confirm the news. Notably, the debt problem of another major developer, China Evergrande, is being handled by the Chinese authorities differently. In September, a criminal investigation was launched against its founder. As a result, the problem of economic recovery will be solved by other methods. While China's markets are reducing demand due to increasingly devaluation, the Asia-Pacific region is also suffering economic losses. The Australian and New Zealand currencies have been particularly sensitive to the fall in consumer prices in its main trading partner. Today, they also came under pressure from the stronger US dollar. As a rule, the sell-off on Wall Street pushed the Aussie down. Therefore, the Aussie dollar pair consolidated within the daily range of 0.6352 and 0.6373 at the beginning of Friday. The Aussie may post its biggest weekly decline in recent months by the end of the Asian session, and the pair remained in the bearish zone near 0.6360, losing about 2.5%. The New Zealand dollar is also being wound down by falling oil prices, an uncertain economic recovery in China, and the strong greenback. The Kiwi hit a new 5-day low of 0.59 today. In addition, the divergence in monetary policy between the US Fed and the Reserve Bank of New Zealand is likely to increase with the prospect of an interest rate hike in the United States. As a result, the Kiwi closed today's trading session in the range of 0.5886 and 0.5905. The Indian rupee looks more confident today, mainly due to the potential intervention of the Reserve Bank of India. Yesterday, the head of the country's central bank said that despite global problems and economic fragmentation, the Indian economy could strengthen in the face of uncertainty. Notably, the Indian rupee has been trading in the range of 83.00 and 83.35 against the euro since September. Against the US dollar, the Indian currency surged to 83.4. However, the rupee depreciated to 82.25 per US dollar in November. This was a record high after September's level of 83.30. The main reason for the rupee's depreciation is explained by a steady outflow of capital from the Indian economy. That's all for now. Stay tuned for more updates with the InstaForex TV. We appreciate your feedback. Please leave your questions and comments below. See you next week.